In another top story, it's the first day on the job for Google co-founder Larry Page. Today, he retook the reins of the company as CEO from now chairman Eric Schmidt. His first big test comes on April 15th. That's when Google reports its earnings. Google is one of Ryan Jacobs' largest holdings. He's chairman and fund manager at Jacob Asset Management, and he manages specifically the Jacob Internet Fund. It has outperformed 98% of its peers over the past month and for all of 2010. He's also a pioneer in terms of internet stock investments. Ryan joins us from our Washington, D.C. bureau. Ryan, thanks for coming on Bloomberg TV. So
thanks for having me.
Let's talk about Larry Page and what sort of expected of him, because when this change was announced, a lot was talked about in terms of the company not needing adult supervision anymore, or that is Larry and Sergey not needing adult supervision anymore. So do you think he really steps into this role and embraces it and becomes that adult CEO?
Well, we'll see. I think there are two main reasons for this move. One is the fact that Larry clearly is ready to take this more formal role with, quite frankly, a lot more responsibility. But I also think a secondary reason is that, the company really, rather when they started or became public, was focused more on Microsoft as a competitor. Now they're looking at young startups like Facebook as competitors. And it's really to have Larry as the face of the company as a CEO, I think will be very important.
And how does Larry and how does Google sort of handle also the credibility issue perhaps that Google is having? I mean, when it was up against Microsoft, Microsoft was the big bad competitor. And now Google itself is that to many of these smaller and younger companies. How does he manage that?
Very carefully. It's really one of the biggest challenges. I think, right now in Silicon Valley, we're seeing a war for talent among startups with, very good prospects, and a company like Google that is seen as an incumbent. It's really up to Larry, and I think he understands this, that in order to really retain that talent and attract new talent, they really have to focus on product innovation and really position the company as forward-leaning and aggressive in attacking new markets.
Do you think that Google with Larry on top of it, as opposed to Eric, is more appealing in terms of young folks in the Valley who are looking for jobs?
I do. Larry is an entrepreneur. He's a founder of the company. I think that it's a very compelling storyline that they can tell prospective employees, and one that it implies an environment that really fosters creativity and new innovations, and I think that's critically important.
So do you think sort of the biggest challenge for Larry going forward is going to continue to innovate in that fashion and grow Google sort of from a more creative perspective?
Yes, and that's really where Microsoft has stumbled. So, in order for them to, now they're a very large company, obviously, they still have to foster that small company mentality, and it's going to be difficult. But I think they understand the challenges. I think now going from 3 CEOs, the triumvirate, to one with Larry as the head person, I think will help clear lines of communication and hopefully make that process much easier to implement.
Ryan, if we could, I wanted to turn to some of your other picks and your other big stocks in your portfolio, because what stood out to me, I mean, you got Apple, you got Google in there, sort of the biggies, and then one of your top positions is in a smaller company called LogMeIn, which provides sort of remote services to folks. When you compare it to some of the big guys in tech, why is an investment in a company like that appealing?
Well, in our mutual fund, we really do range between small, mid, and large cap technology companies. LogMeIn is in a very unique position in the remote access market. They offer a free product competing against a product that maybe others have heard of called GoToMyPC. It's called a freemium model, where they offer the base product for free and then try to upsell other services or advanced products. They have over 10 million customers worldwide, only about 5% pay. But it's a very compelling model where they have a certain amount of scale, where even with only 5% of their customers paying, it's still very, very profitable, and they have great margins.
I got to say, my eyes popped out a little bit when I saw the valuation of this thing. I mean, when you're looking at an Apple or a Google, they trade under 20 times, closer to 15 times forward earnings. This stock is at 66 times of forward earnings. I mean, you're obviously paying a huge premium for this company.
Well, LogMeIn's peers are other companies that we would call software as a service. So a lot of these companies, because of their subscription-based, earnings tend to be under reported. So we look on a cash flow basis. It's trading a little over 20 times cash flow, which for a fast-growing, aggressive company like LogMeIn with great margins is not too high a price to pay. Much cheaper than some of the leaders that we own, quite frankly, like Salesforce.com or maybe a SuccessFactors. So actually, we think relative to its peers, given its growth rate and given the fact that they've acquired this significant asset that would be very attractive to a lot of larger tech companies, we think the valuation is actually pretty good.
Now, if we could, I wanted to take a step back and sort of look at the broader internet stock universe, if you would. You're somebody who started out early in the internet investing world, if you will. You sort of rode things up, you rode things back down again, and since then you have come back considerably. As you well know, there's a talk again about a bubble forming in Silicon Valley. Having lived through one yourself and suffering for it, what's your view of what's going on in tech right now?
There's a lot of differences. I think it's understandable why people would be a little afraid. The big difference is, like you mentioned, the larger companies we own trade at very reasonable multiples to earnings. Even a lot of the startups, even some of the companies that aren't yet public, have significant revenue and in some cases generating significant cash flow. So these new crop of companies that we'll see come public over the next year will come public at have a much different profile than the companies we saw in the late 90s. They're going to have significant revenues, significant profits, as well as significant growth prospects. So I think we're entering this new period right now where over the next year and probably a year from now we'll see Facebook come public. But even leading up to that, we'll see a lot of high-quality internet and technology-related names come public that are, quite frankly, a much higher quality.
Are there any sort of subsectors within internet or within tech that you do think are getting overheated?
I mentioned Salesforce.com. It's a holding of ours. It's one we've cut back in the past. I think you do have to be somewhat valuation sensitive. A company like OpenTable, quite frankly, we think it's a great business model. The only thing negative I can say about it is really that, at 40, 50 times cash flow, it's just too expensive relative to its prospects. So I think you have to be really careful. When you look at the difference in the tech market today, I look at old tech and new tech. Old tech trading at very reasonable multiples, some of which deserve to. New tech, a lot trade at very high multiples, but some deserve also to trade at those high multiples. So trying to navigate between the two is a challenge, but one with our experience, we think we can navigate pretty well.
Ryan, thank you so much for your time. We appreciate it.